Hey everyone, welcome back to the Smash Property Market Update for May. This episode, we're going to be unpacking data from CoreLogic, DSR Hotspotting, Australian Bureau of Statistics, plus all the data that we have collected over the month to give you an insight as to what is happening out there in the Australian property market. As usual, we're going to take a first helicopter view at what is happening more broadly across the country, and then deep dive into some specific markets based on certain strategies you might have. If you're looking for cash flow, if you're looking for growth, if you're looking for certain value spots, we're going to unpack all of that and more in this episode today. As always, none of this is financial advice. This is just me as a buyer's agent sharing information that I see for you guys out there who might want to be doing it yourself. Or you just might have a keen interest in, the property market and what's happening out there. So let's dive straight into it. And we like to keep things pretty casual here. I don't want to make myself sound too smart and throw in all this jargon that doesn't make any sense. So we'll keep the language pretty plain and simple. Now, looking at the national property market for the data from April. So the median house value did increase by 0.3%. And essentially what that means in dollar terms for the median value is that the property prices at a median level increased by about $2,700 in the month. Now, in isolation, that might seem like not a lot comparative to the overall value of the property. But this is why I always say for people that are kind of sitting on the fence and you're kind of like waiting for the right moment, and I always say it's just costing you money because of this exact reason, like the property price. And we're just talking at the median level, obviously, but every month the properties do sort of creep forward for the most part. Now, obviously not every market, but for the most part, property prices do increase as we are seeing, and we'll obviously keep a track on that every single month moving forward. Interestingly, regional markets are still pulling ahead of capital cities. So for the month of April, the regional markets are up 0.6%, and they beat the capital cities. The capital cities only pushed forward by 0.2%. And we'll get into the breakdown of the capital cities in just a second. As always, houses, not as always, for the most part, houses are leading the way, up 1.1% in terms of growth over a 3-month period, while units only crept up 0.5%. So if you're ever wondering houses versus units in terms of growth, that data suggests that houses are doing better at this particular point in time. Rents are still growing, but a little bit slower than what they once were over the last couple of years. So we are at a 2-year high of 3.73% in terms of gross yield nationally. And interestingly, regionals are again ahead with a 4.41% gross yield nationally in regional locations. Now, looking a little bit further down the line, we've got potential RBA rate cuts on the way. Now, that is obviously going to lift the borrowing power of a lot of people, probably towards the back half of this year and maybe into 2026. And I think you don't need to be a rocket scientist to put 2 and 2 together with that and the impacts further putting pressure on an already strained system out there at the moment. Now, let's take a look at the capital city performance for the month of April, looking at each of the capital cities. Now, interestingly, Darwin is leading the charge and has grown the most in the last month, up 1.1%, which is significantly up on any other major capital city, which is very, very interesting. So Darwin, up 1.1% in the month of April. However, when we take a step back and we look at the overall 12-month performance, it is only up 2.5%. However, it's got the highest yield right now in the country, sitting just under 7%. So when we look at some of the other majors, we've got Brisbane up 0.4%, Adelaide up 0.3%, Perth sort of had a little bit of a surge, up 0.4%, and Melbourne and Sydney tied at 0.2% there. So this is, and if you're kind of new to understanding all this data, this is all very normal pushes forward in terms of monthly growth. But I think, again, it's important to look at those numbers and go, all right, well, if I'm sitting on the fence here, prices are in these capital city markets, for the most part, are just getting more and more expensive. Yields across most of these capital cities are sitting, mostly under the 4%, particularly in the majors. Obviously, the outlier there being Darwin, sitting at 6.6%. Now, Darwin is obviously the most affordable capital city at the moment, with a median value of $526,000, which is significantly less than the major capital cities that we've got here, and less than half of what it is in Sydney, which is insane. Still can't wrap my head around this. How far Sydney has really gone. I wanted to talk a little bit about some standout locations to watch and why. Now, I'm not recommending to buy in these locations. This is purely to look at what the location is and what's actually happening, and the reason why we might want to start looking and paying attention to some of these markets. Now, obviously, the first one here for me is Darwin. Now, what's happening in Darwin is it is rising very, very quickly. You've got 79% of suburbs trending up in terms of price growth. You've got rents at a very, very all-time high, obviously reflected in the yields we just spoke about, which are at 6.6% or very close to 7%. Now, am I buying in Darwin? No. I think it's rising fast because of the affordability factor, and the yields are obviously very appealing there. So, an interesting one to watch for the short-term growth that you could potentially get. I wouldn't be suggesting that Darwin is going to be a strong long-term performer as things move forward. I really just think it is the affordability that is attractive to a lot of people right now, coupled with the fact that the yields are very, very good. Now, another standout location to watch is Bundaberg. Now, Bundaberg has had a lot of growth, as a lot of the southeast sector and central Queensland sector has had over the last few years. Now, I'm buying in Bundaberg, but I'm buying smart in Bundaberg and trying to stick in and around the 500K mark, which is very, very difficult, and not really trying to push any further north than the 550 mark. So I like Bundaberg for the fact you can still get in and around the 500 mark. You've got good yields of around 5.5% to 6%. And obviously that the hospital redevelopment there is really adding a lot of new jobs and sustaining a lot of jobs in the area too. So I really do like that market as well. Rockhampton has been a major standout performer for a very long time. We've had a lot of clients there double their money in like 12 months in Rockhampton. Good infrastructure. Plus, there's a bit of manufacturing investment, which is lifting local jobs and therefore impacting the rental market as well. Now, again, Bundaberg and Rockhampton have had a lot of growth. If you are thinking about those markets, you want to be buying, in my opinion, on the lower end of those markets. So you don't want to be doing these 600, 650, 700K prices in those markets. You can get in Brisbane for that sort of price point. Obviously, the yield's not going to be as good in Brisbane. However, in and around that sort of 500K mark, I do believe that it is very good buying. You get a good balance of growth and yield in those markets, and I'm a big fan. Plus, you also get some massive block sizes as well. And as we always talk about, the option to add a granny flat to increase your cash flow later down the line is always a great option. So definitely some standout locations to watch there. Logan and Moreton Bay got very, very strong migration flows in Brisbane, if you didn't know. There's a lot of infrastructure that's going on to really just beef up the area in terms of people moving around and just increasing overall productivity, which is always great. We've got a very, very low vacancy rates of less than 1% in those markets. Now, Logan, as many of us know, has had a tremendous amount of growth in a very, very short period of time. I wouldn't necessarily be recommending Logan, at this particular point in time. However, Moreton Bay on the northern side of Brisbane, I've personally got properties up there and have had for a long time. I do believe that sort of pocket between the north of Brisbane and the Sunshine Coast is going to perform very, very well. And if you've got the budget of up to 800,000, that might be something to really look at in those markets as well. Adelaide is this is a long term. Mr. Consistent is Adelaide. You've got stable growth over a very long period of time now. And you've got some pretty good yields in the northeast pocket of Adelaide. So definitely a location to watch. Now, Melbourne, which is on everyone's minds, the speculators, the outer ring suburbs of Melbourne. The affordability is drawing a lot of owner-occupiers to the area, as well as first home buyers as well. So we need to just be cautious. If you are buying in those markets, I believe you want to be buying in some of the value pockets. You don't want to be getting into, the emotional owner-occupied territory where you get caught up in a bidding war or anything like that. Over the long term, I do believe Melbourne is going to be very, very well. Am I buying there right now? No. But I think if you're an investor that kind of just wants to park some of cash in a capital city, it's still very, very affordable. You can afford to hold the property because the rental yields down there are still nowhere near Brisbane. I think you'd be lucky to get 4.5% in for the most part. I know there are going to be other locations that get closer to 5%, but for the average punter, I think the 4.5-4% yields are what you could expect. If you can afford to hold that, and it's not going to hold you back in terms of maybe growing your portfolio further or impacting your lifestyle, then I would suggest Melbourne might be a good long-term play moving forward. So let's look at where to focus based on your strategy. Now, if you're chasing cash flow, and I might just caveat this, that if you're chasing the pure cash flow for a passive income, residential is not the best asset for that. Commercial would give you a much better overall net yield. However, I know there are some investors, which has been myself included at certain points, that need to balance out growth assets with a bit of cash flow and want to stick in the resi space. These are some markets that you might want to consider. So Darwin, like I've just mentioned, it's still the highest yield in the country. You've got 6.6% gross yield in Darwin. You've got rents that are actually rising. You've got very, very low vacancy rates and a strong, solid demand. So Darwin would be an area where you'd want to consider. The flip side to that is that you're not going to get that sustained long-term growth, in my opinion, in Darwin over the long term. We might get some short-term fluctuations, which we're starting to see. Obviously, the last month, just up 1.1%. But just keep that in mind. It will be a good cash flow play, not a good long-term growth play. If you're chasing cash flow, regional South Australia sort of flies under the radar. It gets a little bit sort of overshadowed by some of the regional Queensland, regional Victoria markets. But places like Port Augusta, Whyalla, still very much under the radar with very, very strong rental returns. Again, I don't like those for long-term growth plays. So if you're going to go into those markets, just know that you're not really going to expect much growth there. However, the cash flow is really, really nice. We want to just be cautious around the areas and the pockets of those towns that we look at, just in terms of the demographic there, and pay attention to vacancy rates and demands in those areas as well. Now, there are select Perth pockets that still have yields well above 5%. Maylands, Cannington and Wellard all still holding up well above the 5% mark. And if you're looking at Queensland, or you want to stay in the Brisbane market, some of the Brisbane units still are showing very, very good cash flow. Woodridge, Upper Mount Gravatt still give you a good yield with a little bit of upside for growth as well, in my opinion, moving forward. So if you've got a budget of $500,000, in my opinion, you want to be looking at Bundaberg, Rockhampton, Gladstone. They are still affordable. They still have very, very strong rental demand, and there's still a lot of momentum behind them. Yes, we've seen a lot of growth over the last few years in those exact markets, but from the data that we can see, this is not just a short-term spike. This is not just a COVID blip. This is sustained demand now over a number of years, and I do believe that we do have some strong momentum, like I mentioned, moving forward in those markets. If you are buying in and around the 500K mark, I would not recommend going any further, over 600,000 in those markets. There are way better places to be investing for that budget. But I know a lot of people are in that sort of 500K mark, and those markets are really, really good. North Adelaide, Monopara West, Modbury, Mawson Lakes, plenty of value there, and also some very, very low vacancies for investors in that 500K mark. Again, the outer suburbs of Melbourne, Sunbury, Werribee, Craigieburn, they're all sort of bouncing back with a lot of buyer interest in those particular pockets as well. and also Palmerston, so the southern side of Darwin, Durick, Malden, Gun, all seeing sharp rises in sales activity. So if you've got a budget in the 500k range, you want to be looking at those markets, in my opinion. Now, if you've got a budget of 800,000, I love Gold Coast, northern side of Brisbane, and even some pockets of the Sunshine Coast. All those areas have very, very strong owner-occupier appeal. And as an investor buying where the owner-occupiers are, it just gives your property a bit more of an advantage and appeal for tenants. So you can sort of limit the vacancy rates that you have there. And all of those markets I just mentioned have very, very strong growth signs moving forward over the next sort of 5 years, or 5+ years actually, as we head into 2030. Budget of around 800k still, inner to north, Adelaide, Campbelltown, Modbury, Prospect. Lots of demand and still reasonable value in those pockets if you are very selective in looking at those markets as well. Some things to watch. Markets to be selective in. Now, I'm not saying these markets are terrible, don't buy there, but I'm just saying be a little bit cautious when you are looking at these markets, if you are at all. Now, I've said it in the last month's update, but Greater Perth, 57% of suburbs are now on the decline or they have plateaued. So Rockingham, Baldivis, I think you say it, Coolangatta, have all dropped off slightly. So just be cautious around wanting to move into those markets. That's not to say the whole of Perth is screwed. It's just be careful about some suburbs have just had a massive pump. They've flatlined, and now in some stakes they have started to decline. There are still some reasonably good suburbs there, but all I'm saying is just be cautious around that. Sydney, so LGAs like Parramatta, Fairfield, North Sydney, they're all showing signs of weaker sales volume, and that then does reflect in prices sort of slowing down, plateauing. Again, I'm not saying those markets are bad and terrible. They're just not, showing some great signs. Hey, this market's about to pop. So overall, my take on the state of the current Australian property market, there's always noise in the media. Every sort of week, every day I see there's, home buyers are screwed, investors are screwed, house prices are rising, house prices are falling. I always say that just to don't get caught up in that sort of hype. Like let's look at, what is the actual data driving this whole decisions here? And right now, if I had to pick one corridor to focus on, it would be Southeast Queensland. And that sort of central section of Queensland as well, the Bundabergs, the Rockhamptons. Now, why am I saying that? And I have said it for a very long time. Suburbs like, Redlands, areas like Redlands, Moreton Bay, even Sunshine Coast, you've just got very, very strong buyer appeal. You've got very, very tight vacancies. So when you do buy a property, it's very, very easy to get tenanted out. You've got rents that are steadily climbing. I've got properties in these markets and they've been steadily climbing for a long period of time without showing signs of actually slowing down. Obviously, things like the Olympics, adds a little bit of sprinkle on top, but the infrastructure really is a big thing now. Infrastructure is good for obviously creating jobs. It's good for making the city more efficient, people just moving around and lifting the overall economy as a whole, which is happening in and around the Brisbane area. Bundy, the hospital, like we've spoken about, $1.2 billion for that central region to have a hospital. Now, that's a game changer for creating more jobs in the area, not only for construction, but obviously for occupying the hospital moving forward. And that just puts pressure on housing, which we are seeing and have seen for a long time. So if you are buying in Bundy, buy smart, buy it with a good appeal, and you're going to do very, very well out of it. Same with Rockhampton. It had this massive growth run, I'd say maybe 2 years ago, 18 months ago. And I thought, Rocky's done. But it's sort of quietly becoming like a bit of a hub for logistics and manufacturing. Rents are increasing. Property prices haven't really caught up to where the rents are. So you've got some very, very strong yields there. And I do believe the prices do have a bit of a way to go. So I love the central Queensland region, Bundy, Rocky. for its affordability factor, its cash flow, and the growth runway that it does have left. If you've got a bit of a higher budget, like I mentioned, I still do love Brisbane for the reasons of that future growth potential, like I just mentioned. Also Adelaide as well. It's just been a very consistent performer. I'd just be very picky around which suburb, what price point I'm getting into. So look, there's lots of hype out there. There's lots of different opinions and views. At the end of the day, this is data, and you can interpret data in many different ways. So that is my interpretation of the Australian property market as it stands at this point in time. So I hope you got some value out of that. Trying to make this as sort of practical as possible, so we're not just blurting out numbers and it going over many people's heads, but giving you info that you can actually take away and go, oh, okay, let me go and look at this area, let me look at that area. If you are doing it yourself, by all means, you can get into the property market yourself these days, despite what many other BAs say, despite what many people that are selling property courses say. You can do it yourself. If you don't have the time, you don't have the confidence, or you just want to outsource it because you just want to outsource it, then that's when a buyer's agent can be useful. If that's you and you're in that boat, reach out to us at smashpropertyinvesting.com.au. We're on all the socials. You can send us a DM on Instagram or Facebook, wherever it might be, or give us a call, 0452046274. We specialize in that affordability price range of around the 5 to 800K mark, making sure that we can balance both growth and yield for you, so the property doesn't burn a bloody hole, in your pocket. And for us, it's really looking at how we can actually grow your portfolio, not just get one property and see you later. It's like, how does this one affect property 2 and 3 and moving forward like that? So if you're looking to really grow and build a portfolio like that, that's what we specialize in, as well as having a good team of an accountant and a broker that can really get you the right financing and structuring options as well, and we'll sort out the property. So that's it for the property market update for May. Hope you got some value. If you did, drop a like, subscribe if you haven't already to the channel. It does let me know that you do appreciate these videos. Until next time though, thank you so much for watching. I'll catch you soon.